Hello, everyone. Welcome back to Company Founding 101 Class 11. And today we're going to talk about VC and angel investment. This topic is crucial because angel investment and VC are what you guys will be interacting with the most to get funding because there are a lot of VC companies and angel investment companies. And you might ask, what is venture capital? Venture capital is a high risk, high reward funding resource provided by these firms to have high growth potential startups. So they really invest in stages extremely early, and from the early to the expansion and later stage. And this structure helps distribute risk and aligns investment with the growth trajectory. So as we know, when you invest something in the early stage and then it suddenly got big, you definitely are going to get more return than you invest in the later stage. So now this leads to angel investing. So angel investment is basically the first form of external funding of startups. So it's normally provided by affluent individuals, and it doesn't have too much organizing power because this goes to the pre-seed stage. So it's extremely early. A lot of angel investing starts with if someone presents you an idea, you just invest in it. That's what I am doing with Sun Endowment. But I'm not asking for a, you know, percent equity or like dividend or something like that. So they often bring more than just capital to the table because those affluent individuals have experiences in creating companies and stuff like that, and which is really beneficial to early stage startups. So what are the differences between the two? So VCs typically invest in larger amounts, but they require more control of the company and faster, higher returns. Angel investor, on the other hand, offer a personal touch, for example, like personal advices and experiences, and more hands-on to have more, and they have they are looking into a longer term return horizon. So understanding the difference will makes us understand which one is the best for you to go for. And the venture capital process begins with deal sourcing and followed by due diligence on the market, product, and team. And after a positive investment decision, VC firms provide active oversight during portfolio management. And the process concludes with the exit stage. Usually is in the IPO, which is the first public offering to make the company to go public on the stock market. So that's when they exit and sell their share. And the angel investment process is, like I described before, is quite different. And they identify potential startups often via personal networks or pitches. So, for example, if someone emailed me and proposed me an idea and I really like it, I'll just invest in it. And then there's a detailed evaluation of the opportunity, risk, and compatibility because as we know, that angel investment needs personal touch. So if you are not going to work well with the other person, the compatibility is just not there. And then they negotiate investment terms and maintain an ongoing mentorship-oriented perspective. And of course, they aim for profitable exits, else they won't put their money into it. So by going to these two sources to ask for funding, you need to have a good pitch deck. So it must be clearly showcase the problem you're tackling, the solution you're proposing, a business model of how you're gonna profit, how big the market is, and how capable your team is, and the financials currently. And it's essential to create compelling narratives because a lot of you have to present your idea well. And those, like for example, marketing model team I have explained in previous videos. I think if you guys don't understand what those is, you can take a look to the previous videos, and it will probably give you a really thorough explanation. So the elements of a pitch deck includes a clear problem statement, innovative solution, because you don't want to be same with everybody else. You have to have something that makes you special and stand out, and also a capable team. The robust financial projections is crucial because a lot of angel investors are looking at those numbers because they want to see, oh, what can I get back from my investment and how worth it is it? So that is crucial as well. And each element must reinforce the startup's value proposition and growth potential. And the presentation skills, like I mentioned before, is crucial. And you might have learned, public speaking in one of your classes, and that's when this comes into really handy places. Because it isn't just about the content, it's also about the delivery. In China, there's the old saying that it's better if you know how to present a thing than you actually do it. But of course, you need to do both things really well in order to get the VCs, angel investments funding. You got to practice your pitch. You can't just go first go because it's going to be nerve-wracking when you talk to those people, and those people really know how to pinpoint the questions. And you have to engage with them, address the questions directly, and display your passion for business. Avoid common mistakes such as overpromising, ignoring competition, and lack of clarity. So I think there's a pretty popular show called Shark Tank. If you guys don't know what it is, you should search it up and go watch it because I think it's a really good show that teaches you there was a successful pitch and was an unsuccessful pitch, and you can learn from it. So now we come into negotiating investment terms. Term sheet outlines the key terms of the deal. Understanding what terms like valuation, equity, voting rights, and anti-dilution provisions mean is crucial. This will be provided in the class I'm developing right now, which is focused on key terms. And legal advice is essential to ensure, fair negotiations to protect the startup's interests. Now we talked about all the terms. Now we need to structure a deal. Deal can be structured through equity, convertible notes, or a simple agreement for future equity. And understanding how these affect valuations and equity distribution is crucial. It's about striking a balance between funding needs and maintaining control. So post-investment, if they invest in you, that you have to maintain an ongoing relation. Maintaining transparent communication and strong relations with your investor is vital. The level of investor involvement may vary, but always be prepared for follow-on funding rounds if needed. So believe you can be successful, and thank you so much for listening. I'll see you in the next video.